Welcome back to the Deep Dive. Today, we're going to be exploring something that I know a lot of you have been asking about. It's how to build wealth, and particularly how to do it through real estate and supporting growing businesses. But, maybe you're not really eager to become a landlord, or you don't really want to have to sift through tons of small business investment opportunities. So what if I told you there were vehicles designed to simplify all that?
That's true. Real estate and SME investments are attractive, but the practicalities can sometimes be a little daunting. That's where this deep dive gets interesting.
Yeah, for sure. And we are very lucky to have someone with us today who literally wrote the book on this. The book is called BDCs and REITs, Keys to Maximizing Your Returns. And our guide today is the author himself, Dr. Philippe CADIC. Welcome to the Deep Dive.
Thank you. It's a pleasure to be here.
Okay, so before we get into the nitty-gritty, let's just demystify these terms a little bit. Can you give us a clear definition of what BDCs and REITs actually are and why they might be attractive to someone who is looking to build wealth?
Absolutely. So let's start with business development companies, BDCs for short. These are companies that act as a bridge between investors like you and the world of small and medium-sized enterprises. Those, engines of growth, as we often call them. BDCs pool money from investors, and then they use it to provide funding to these SMEs, both loans and sometimes equity. What makes them particularly appealing is that they're required to distribute at least 90% of their taxable income to shareholders as dividends. This translates into potentially attractive returns, often exceeding 6% annually.
Wow, 6%. That definitely catches the attention. It sounds almost like getting a direct share of the profits from these growing businesses. But I have to ask, what's the trade-off here? High returns usually mean there's some degree of risk involved.
You're right to be cautious. While BDCs offer compelling potential, it's very important to understand the inherent risks. We'll get into those a little bit later on.
Okay, duly noted. Now let's switch gears to REITs. How do they differ from BDCs, and how do they connect to that, dream of building wealth through real estate?
Okay, so REIT stands for Real Estate Investment Trust. Just like BDCs, REITs are required to distribute at least 90% of their taxable income as dividends, but instead of funding SMEs, they invest directly in real estate assets. Imagine a portfolio of properties, shopping malls, office buildings, apartments, even specialized things like data centers or cell towers. REITs own and manage these, offering investors a way to participate in the real estate market without the burdens of direct property ownership.
So for someone who, they like the idea of owning real estate, but they don't want the headaches of being a landlord, REITs could be a more hands-off approach.
Precisely. REITs provide diversified exposure to real estate, potentially offering both income and appreciation.
Okay, so we've talked about attractive returns. We've talked about real estate exposure. These both sound great. But let's flip the coin here a little bit. What are some of the potential downsides or risks involved with these investment vehicles?
Well, with both BDCs and REITs, a key factor is interest rate sensitivity. As interest rates go up, their borrowing costs increase, and this can cut into profits and potentially impact those attractive dividends. Additionally, they're both subject to market volatility, just like any other publicly traded asset. Economic downturns can impact their performance, and share prices can fluctuate.
So it's not just a guaranteed ride to riches. There are external forces at play that can have an impact on returns.
Exactly. Due diligence is key. Don't just chase high yields without understanding the underlying fundamentals and potential risks.
And this brings us back to your book, BDCs and REITs, Keys to Maximizing Your Returns. I understand that this book provides a framework for navigating these complexities.
That's the goal. This book is designed to empower individuals, especially those who might be new to these investment vehicles, to make informed decisions. It delves into things like analyzing financial metrics, understanding portfolio composition, assessing management quality, and even, using tools to track performance and manage risk effectively.
So this is a great starting point for anyone who's feeling a little overwhelmed right now. But before we urge everyone to go buy it, can we get into some real-world examples? Can you share some success stories, maybe some cautionary tales that really illustrate the potential, but also the pitfalls of BDCs and REITs?
Of course, of course. So let's start with BDCs. One company that really showcases resilience is Main Street Capital Corporation. Their ticker symbol is MAIN. Even during the 2008 financial crisis, when the S&P 500 plummeted over 38%, MAIN continued to provide stable dividends, which demonstrates their conservative management style.
That's impressive. Weathering a storm like that really suggests a certain level of stability and expertise. But you also mentioned cautionary tales as well.
Indeed, indeed. So, Prospect Capital Corporation, or PSC, offers another perspective. While it's known for its high yields, it also carries more debt and has a more concentrated portfolio. This translates to greater volatility and sensitivity to interest rate fluctuations.
So higher potential reward, but also higher risk.
Yeah.
Seems like diversification, not putting all your eggs in one basket, can be crucial.
Absolutely. Diversifying across different BDCs, different sectors, even considering adding REITs to the mix can help mitigate risk.
Now, speaking of REITs, are there any standout examples that you can share? Companies that really exemplify the potential of this investment vehicle.
One classic example is Realty Income Corporation. Their ticker symbol is O, and they're famously nicknamed the Monthly Dividend Company. They have a long history of paying consistent dividends and focus on commercial properties with long-term leases, which is very appealing to income-seeking investors.
Monthly dividends, that does sound appealing. But are all REITs focused on, steady income, like realty income? Are there options out there for investors who might be looking for more growth potential?
Certainly, certainly. Consider Prologis, Inc., ticker symbol PLD. They specialize in logistics warehouses, a sector that's experiencing rapid growth due to the rise of e-commerce. While their dividend yield might be lower than realty incomes, they offer potential for higher capital appreciation. This caters to investors seeking a blend of income and growth.
So realty income, kind of the slow and steady approach, and Prologis tapping into a really dynamic growth trend. It seems like choosing the right BDCs and REITs hinges on understanding your own personal investment goals and risk tolerance.
You've hit the nail on the head, and that's where the book comes in, providing that framework for aligning your investments with your individual objectives.
It sounds like we're just scratching the surface here. Before we move on, is there anything else about BDCs or REITs that investors should be aware of that we haven't really touched upon yet?
One crucial aspect we haven't fully explored is the tax treatment of BDC and REIT dividends. That 90% distribution rule we discussed has some interesting implications for investors come tax season, and it's something we should definitely unpack further.
Yes. The tax man always wants his share.
Mm.
That's a great segue to part 2 of our deep dive, where we will unravel the complexities of taxes and regulations surrounding BDCs and REITs. Stay tuned.
Welcome back to our deep dive into the world of BDCs and REITs. We've explored their potential for building wealth, but as with any investment, it's crucial to understand the rules of the game. So let's shift our focus a little bit to the regulatory landscape and those tax implications that we touched upon earlier.
All right, let's unpack this a bit. I'll be honest, regulations aren't usually the most exciting part of investing, but I do understand that they play a really vital role in protecting investors and ensuring transparency.
Exactly. In the case of BDCs and REITs, regulations are there to make sure that they operate responsibly and, stay true to their core purpose. Supporting SMEs and providing access to real estate. Remember that 90% distribution rule? Well, that's actually mandated by the Investment Company Act of 1940. This is the same law that governs mutual funds. This, along with some later amendments specifically for BDCs, aims to protect investors and promote stability in the financial system.
So that high dividend payout isn't, just a marketing tactic. It's the law. What other obligations do BDCs have to follow?
There are several. For instance, BDCs are limited in how much debt they can take on, typically a 1.1 debt-to-equity ratio. This prevents them from becoming over-leveraged and taking on excessive risks.
That makes sense. Too much debt can be a red flag for any company, especially when we're talking about investing other people's money. What about ensuring that, BDCs are actually investing in those engines of growth, the SMEs?
Right. To maintain their BDC status, they're required to invest at least 70% of their assets in U.S.-based SMEs, which are defined as companies with a market value under $250 million. This ensures that they're fulfilling their intended purpose.
Okay, so no sneaking off to invest in, speculative tech startups or anything like that. They have to stay focused on supporting smaller businesses. I like that. But how can investors actually verify that BDCs are following these rules and being transparent about their operations?
Transparency is a cornerstone of the regulatory framework. BDCs are required to publish detailed quarterly and annual financial reports, which include information about their investments and management fees. This allows investors to see exactly where their money is going and how it's being managed.
Okay, that level of disclosure is definitely reassuring. It really gives investors the tools they need to assess the BDC's performance and make informed decisions. Okay, so we've covered the distribution rule. We've talked about debt limits, investment requirements, transparency. Let's tackle those tax implications that you mentioned earlier. This is where things tend to get a little complicated.
You're right. Taxes can be tricky. So because of that 90% distribution rule, BDCs act as pass-through entities for tax purposes. This means they don't pay corporate income tax on the dividends they distribute. Instead, the tax burden falls on the individual shareholder.
Okay, so when I receive those tempting BDC dividends, how are they actually taxed?
Well, it's not as straightforward as just saying it's, taxed as regular income. The exact treatment actually depends on several factors: your holding period, your overall tax bracket, and the nature of the dividend itself. So some portion might be taxed as ordinary income, while other parts might qualify for a lower rate as qualified dividends.
So there are nuances to consider. It seems like, consulting with a tax advisor might be a wise move, especially for anyone who is new to BDC investing.
Absolutely. Tax laws can be complex, and a professional can help you optimize your strategy.
Now let's shift gears to REITs for a second. Are they subject to a similar regulatory framework?
They are, yes, but there are some key distinctions. Just like BDCs, REITs fall under that Investment Company Act of 1940, and they have to distribute at least 90% of their taxable income to shareholders.
So that high dividend, allure is present for REITs as well. What about other, obligations or regulations that are specific to the real estate focus of REITs?
Well, to qualify as a REIT, a company has to meet specific criteria. At least 75% of its assets have to be invested in real estate, and at least 75% of its gross income must come from real estate rents or mortgage interest.
Right.
This ensures that their primary business is truly, real estate.
So no dabbling in unrelated ventures just to boost profits. They have to stay true to that real estate core.
What about debt limitations? Are REITs also restricted in how much leverage they can use?
It's a bit more complex for REITs. Debt limitations can actually vary based on factors like the type of REIT it is and its overall financial structure. Some might choose to operate with very low debt, while others might seek waivers to take on more leverage.
So some REITs might be more conservative, while others are willing to take on more risk to potentially enhance returns. It's yet another factor for investors to consider. And I assume REITs are also bound by those transparency rules that we talked about earlier.
Absolutely. Transparent financial reporting is essential for REITs, just as it is for BDCs. Investors need to be able to access the information they need to assess the risks and performance. Okay, so we've seen that the regulations for BDCs and REITs share some common ground, but there are also some key differences. What stands out as the most significant distinction between the two when it comes to regulations or tax treatment?
One key difference lies in how REIT dividends are taxed. Unlike BDC dividends, which can be a mix of ordinary income and qualified dividends, REIT dividends are generally taxed as ordinary income.
So REIT dividends are a bit more straightforward in that sense. However, it also means they'll be taxed at my full income tax rate. Are there any potential tax advantages associated with REIT investing that might offset this?
One benefit is the depreciation deduction. REITs own physical properties, and they can claim depreciation on those assets, which reduces their taxable income. This can indirectly benefit investors through potentially higher dividends.
So depreciation acts as a sort of, a tax shield for REITs. It seems like we've only just begun to unravel the complexities of taxes and regulations.
Indeed. These are just the fundamentals. There are many layers to explore, and Dr. CADIC's book goes into much greater detail, but understanding these basic principles is essential for making informed decisions.
This has been incredibly insightful. We've delved into the regulations that ensure BDCs and REITs are operating responsibly, and we've begun to unpack those, tax implications. And as we learn, they can be quite nuanced.
And speaking of nuance, let's move on to the more strategic aspects of BDC and REIT investing. In part 3 of our deep dive, we'll explore some practical strategies for choosing the right investments and building a balanced portfolio that's tailored to your individual goals.
I'm eager to hear more. This is where the rubber meets the road, turning knowledge into action. Stay tuned for part 3, where we'll equip you with the tools to navigate the exciting world of BDCs and REITs. Welcome back to the deep dive. We've demystified BDCs and REITs. We've gone through the regulatory landscape. We even dipped our toes into the sometimes murky waters of taxes. But now let's shift gears and get practical. How do we actually choose the right BDCs and REITs to build a portfolio that aligns with our goals?
That's the million-dollar question, or perhaps the multi-million-dollar question, given the potential of these investments. So the first step, as with any investment strategy, is really understanding your objectives. What are you primarily seeking? Are you looking for income? Are you looking for growth? Or maybe a blend of both?
So someone nearing retirement, for example, they might prioritize those high dividends, right, to get a steady income stream. While a younger investor, someone with a longer time horizon, they might be more interested in that growth potential.
That's a common approach, but it's not always about, fitting into an age demographic. Some retirees might be perfectly comfortable with more risk if it means keeping pace with inflation, while some younger investors might actually value that consistent income stream to reinvest and compound over time. It's really about aligning your investment choices with your personal circumstances and your risk tolerance, not just fitting into a box.
Okay, so goals and risk tolerance, that's our compass. What are the next landmarks on this roadmap to choosing the right BDCs and REITs?
Once you've charted your course, it's time to really dig into those financial statements. Remember those key metrics we discussed? Dividend yield is just the starting point. We need to go deeper,
Yeah.
examining the dividend coverage ratio, the debt to equity ratio, and other indicators that really reveal the financial health and the potential of a company.
Okay, so let's say I'm looking at two BDCs, both with pretty enticing dividend yields. What else should I be comparing to make a more informed choice?
Right, a high dividend yield is attractive, but it's so important to look beyond just the surface. The dividend coverage ratio tells us whether the BDC is generating enough cash flow to actually sustain those payouts. To calculate this ratio, you simply divide the company's net income by the total dividend paid. A higher ratio, ideally above 1, indicates a healthier margin of safety. It means the company is comfortably covering those dividend payments, reducing the risk of a cut in the future.
So it's not just about chasing the highest yield, but looking for a sustainable yield that's supported by strong fundamentals. What about debt levels? How can we assess whether a BDC or REIT is taking on too much risk?
That's where the debt to equity ratio comes in. This metric tells us how much debt the company is using to finance its assets compared to shareholder equity. A higher ratio suggests a more leveraged position, meaning there's potential for greater returns, but also greater risk as well. So if you're more risk averse, a lower debt to equity ratio is generally preferred. And you can find this ratio by just dividing the company's total debt by its shareholder equity.
Okay, so it seems like we're uncovering a recurring theme here.
Yeah.
Balance. Finding that sweet spot between yield, coverage, and debt.
Balance is definitely key. But it's not just about crunching numbers. Qualitative factors matter too. Assessing management quality is crucial. Look at the experience and track record of the team that's running the BDC or REIT. Have they successfully navigated past economic cycles? Do they have a clear and well-defined investment strategy that aligns with your own goals?
It makes sense. Yeah, it's like, choosing a surgeon. You wouldn't just go for the one offering a discount on appendectomies, right? You want someone who's actually good at wielding a scalpel.
Exactly. Experience and expertise really do matter. And then once you've evaluated individual BDCs and REITs, remember diversification. Just as you wouldn't put all your eggs in one basket, spread your risk by investing in a mix of companies, a mix of sectors, and even consider, geographic diversification.
So it's like building a well-rounded portfolio, creating that financial ecosystem that can weather those different market conditions. Is there anything else we can do to stay on top of our investments, especially in a world where things are constantly changing?
Well, technology can be a really powerful ally. There are, tracking tools and alerts that allow you to create custom dashboards to monitor your investments. You can even receive notifications if certain metrics hit those predefined thresholds. So, for example, if a BDC's dividend coverage ratio drops below a certain level that you set, you'll get an alert, which, prompts you to maybe take a closer look.
So instead of constantly, checking stock prices and crunching numbers, I can kind of let technology do some of that heavy lifting and alert me if something needs my attention. That frees up time and mental energy to focus on the bigger picture.
Technology can definitely streamline the process, but it's still important to understand those fundamentals, and that's really what sets Dr. Cadic's book apart. It equips you with the knowledge you need to make informed decisions, not just react to market noise.
This has been an incredible journey. We've demystified BDCs and REITs. We've explored the regulatory landscape. We've delved into taxes, and now we've equipped ourselves with a toolkit for choosing the right investments and building a balanced portfolio. But before we wrap up, what is that final thought-provoking question that you would like to leave our listeners with? Something to spark their curiosity and further exploration.
Here's something to ponder. Dr. Cadic touches on a fascinating development in his book, real estate tokenization platforms. So these are platforms like Realty and Bricks.co. These platforms use blockchain technology to fractionalize ownership of real estate, allowing individuals to actually buy and sell tiny pieces of properties. So the question is, could this be the future of REIT investing? Could BDCs even get involved in this space? It's a rapidly evolving landscape, and it really highlights the importance of staying informed and adapting to new opportunities as they come up.
Tokenized real estate, BDCs on the blockchain. It definitely sounds like we're on the cusp of a new era of investing. A huge thank you to Dr. Philippe CADIC for sharing his expertise and shedding light on these really exciting investment vehicles. And to our listeners, remember, knowledge is power. Do your research, invest wisely, and never stop exploring. Until next time, on The Deep Dive.